I'm going to show you how to calculate the stock price for AbbVie. This is a pharmaceutical company, and I run a discounted cash flow model on companies. That way I can figure out the value of the stock, and then I look at the financial ratios at the end of the video. So AbbVie has a market cap of $173 billion. It's a really big company. And they have stock price of $97.99. So now we know the shares outstanding because it's the market cap divided by the stock price gives you the shares outstanding, 1.8 billion. Next we're going to get the free cash flow. And this is how you value a company, is you estimate the future free cash flows and then you discount that number back to today's value. And that's what we're doing in this video. Next I'm going to pull the net income off the income statement. That's the profit and loss for the business. And I'll put 4 years of revenue into the model. And we want to look at the numbers to make sure they look pretty consistent and positive, because if you don't have both of those, it can make it really difficult to do a discounted cash flow model. And you can see revenue has increased every year, which is a great sign. Free cash flow has doubled from 2016 to 2019, so it seems to be pretty good so far. Now let's figure out the discount rate we need to apply to the future cash flows. So they paid $1.8 billion of interest on their debt. And let's go to the balance sheet, see how much debt they have. So current debt is $3.8 billion, that's due within 12 months. And long-term debt of $63 billion, that's due after 12 months. So they pay 2.7% interest on their debt. Since interest payments are tax deductible, let's get their effective tax rate. And as you can see in 2019, they pay a pretty low tax rate, only like 4 or 5%. So let's pull the 2017 number, that looks more appropriate. So the income before tax is $7.7 billion. And the income tax is $2.4 billion. So when you take the 2.7% and reduce the tax rate, you get a cost of debt of 1.84%. Let's figure out the cost of equity. So we need the beta, that's 0.82. That means the stock moves less than the market, which is good. You want a stock that's not too volatile. And let's get their current assets. We'll go back to the balance sheet for that. And current assets are assets that can be transformed into cash within 12 months. And that's $49 billion. And let's get their current liabilities. Those are liabilities that are due within 12 months. And that's $16 billion. And let's get their equity. And they have a negative equity, which means their liabilities are more than their assets. Now we need the EBIT, that's earnings before interest and taxes, and that's on the income statement. That's the same as operating income, and $13 billion. So to get their weighted average cost of capital, it's a blend of cost of debt and cost of equity, and that comes out to 1.86%. And that's what we're going to use to discount the future cash flows. So we estimated 4 years of future free cash flows. Then we did a terminal value, which is all years past year 4. We discounted those numbers back to today, and we get a value of the company of $193 billion. And when we divide that number by 1.7 billion shares outstanding, we get an intrinsic stock price of 109. It's trading at 98, so it's trading at a discount. It's a 10% discount, so it's a buy according to the model. Historically, the stock has traded, it looks like, in the 80s and 90s for a while. It looked like it peaked about 120 2-3 years ago. So it's been trading pretty close to intrinsic value. Let's see what Simply Wall Street says the stock is worth. They're valuing at $109.45, which is almost exactly what I value it at. So let's look at their financial ratios to get more information on the company. So they have a PE ratio of 21, that's price of stock over earnings per share. And the average in the market is 26. They have a price of sales of 5.2. That means investors are willing to pay $5.20 for $1 of sales. They have a negative price to book because they have negative equity. current ratio of 3.2. They can easily cover their current liabilities more than 3 times. Negative ROE, so we can't look at that. Even though they have a high interest payment of $1.8 billion, their interest coverage ratio is more than 7, so they can easily cover their interest payments. And they're 100% debt because they're negative equity. And if we go to their 10K, we'll look on their balance sheet. And the reason they have negative equity is because they bought back so much stock. They have $24 billion in stock buybacks. And when companies buy back their own stock, then they put it onto the balance sheet in the equity section at a negative because it's taken off the market. And that really drags down your equity value. In this case, it dragged it below 0 to negative. Companies have been buying back stock a lot. It makes their ratios look better. So here are 7 drug manufacturers and their ratios. And this is ABBV. And Biogen is here. They have a lot of orange because they win in a lot of categories. They have the lowest PE, the lowest price to sales, the lowest price to book. And this is the average. So ABBV is lower than the average for price to equity. They're about average for price to sales, and we can't look at their price to book because it's negative. They have the highest current ratio, although you don't really need a 3 current ratio. A 1.5 is more than enough. So in terms of market cap, AbbVie is about at the average. Stock price is fine. They have plenty of free cash flow. It's actually growing. It's up to 12 billion. So they're not in a situation where they're struggling to pay their interest payments. They were just trying to keep up with the Joneses and buy back stock to make their numbers look better. So let me know what you think in the comments. Thanks for watching the video.